Eventually, every Canadian business owner asks the same question. How do I get this money out of my corporation without getting crushed by taxes? There is a solution, and it's been in the Income Tax Act the entire time. It's called the Capital Dividend Account. Hi, my name is Laurent Munier. I'm a partner and advisor here at Safe Pacific Financial, and most incorporated professionals, this could be doctors, contractors, and entrepreneurs, lawyers, accountants, they want to accumulate their wealth inside the corporation to save on some taxes, but very few know how to get the money out efficiently. So the CDA is the key that unlocks tax-free distributions and makes corporate planning significantly more powerful. In today's video, I'm going to walk you through exactly how the CDA works and how you can use it to build and protect and transfer your corporate wealth with greater confidence and less tax. What is the Capital Dividend Account, or CDA? So the Capital Dividend Account is one of the most powerful and least understood tax planning tools that's available to Canadian business owners. The CDA is what's called a notional tax account inside a Canadian-controlled private corporation. Sometimes you'll see this as CCPC. And this notional account tracks specific types of tax-free surpluses. So these can be distributed to shareholders as tax-free capital dividends, which allows you to take money out of the corporation without triggering personal tax. Now, unlike a regular bank account, the CDA doesn't hold cash. Instead, it just records amounts that are received by the corporation that the Income Tax Act allows to be paid out tax-free. When it's managed strategically, the CDA becomes a key part of long-term corporate tax planning, retirement planning, and estate planning. Now, why does it matter for business owners and for incorporated professionals? Now, if you're a Canadian entrepreneur, you're an incorporated professional, this could be doctors, dentists, engineers, consultants, lawyers, accountants, business owners, you own a store or a restaurant, family business. The Capital Dividend Account is one of the most powerful tax-efficient wealth extraction tools that's available, and despite how valuable it is, many corporations either underutilize it or don't even know it exists and don't use it at all. The CDA matters because it gives you the rare ability to move money out of your corporation without triggering personal tax. Now, normally, pulling funds out of the corporation is either a taxable dividend or a salary, which are both taxed at some of the highest marginal rates in the country. But with the CDA credit, your corporation can pay out a capital dividend that is 100% tax-free to the shareholder. There's no gross up, there's no dividend tax, no added personal income, just tax-free money in your hands or in your family's hands. Now, one, you want to extract the corporate wealth without hitting the personal tax. Now, if you've built up significant retained earnings or you've realized capital gains, or maybe you hold investment assets inside your company, the CDA allows you to extract part of that value in a tax-free way. So this is something that standard corporate withdrawal methods just can't match. It makes the CDA an essential tool for long-term tax planning, especially if you're incorporated and you keep most of the money that you have inside your corporation or your holding company. Number two is it allows you to time tax-free distributions. So unlike a traditional dividend or a salary withdrawals, capital dividends can be timed strategically. As long as you have a CDA balance and it's positive and you have the proper election filled with the CRA, you can choose exactly when to pay it out. You don't have to pay it out all at once and you don't have to pay it out right now. So this gives you powerful flexibility to align your distributions with your own goals, right? Your personal tax planning, retirement income planning, corporate restructuring, estate planning, business winding down or transitioning. So the timing flexibility is one of these big advantages that owners would look for in smoothing income or managing tax in a high income year. Thirdly is you can convert your corporate-owned life insurance into tax-free generational wealth. And this is where we come in. This is one of the most valuable and misunderstood uses of the CDA is the integration with corporate-owned life insurance policies. When the insured person passes away, the insured shareholder passes away, the corporation receives that policy's death benefit. Any amount that's above the adjusted cost base gets credited to the CDA. So this makes it possible to move a significant amount of money out of the corporation in a tax-free way. It provides instant tax-efficient liquidity to your heirs, if that's who you want your money to go to, and it can avoid forced asset sales to cover estate taxes when you die. It can also strengthen your business succession plan and finance any buy-sell arrangements that you have if you've got partners in your business. And this is why the CDA optimized insurance planning is one of the core strategies that we use for our wealthier Canadian families to transition their corporate wealth smoothly to the next generation. Fourthly, this is essential for succession planning, retirement planning, estate planning. Now, whether you are transitioning the business, whether you're selling shares, whether you're planning for an eventual exit, whether you're planning for estate taxes, these CDA distributions could do all sorts of stuff like funding your buy and sell agreement in a tax-free way, providing liquidity when you need it for estate equalization, reducing your tax exposure on death, and supporting a tax-efficient wind-down of a corporation. Now, if you're an incorporated professional and you've got significant savings inside your professional corporation or your holding company, the CDA often becomes a key component that can determine how efficiently that your wealth will transfer to the next generation, which is probably either your kids or your grandkids for most of our clients. How does this work? Here's like the quick step-by-step. Understanding how the Capital Dividend Account works, it's really crucial to use it correctly and to avoid costly mistakes because the CRA wants their taxes and anything that has tax-free in it, they monitor that very closely. So like I said earlier, the CDA is not a bank account. It's a tax ledger. It's governed by strict CRA rules. And here's how it works basically from start to finish. But again, you should probably talk to your accountant about this. We don't track your CDA for you. This will be on your accountant. We're just giving you this information so that you know to talk to your accountant. So how does it work? Number one, you need to build up. You need to accumulate the qualifying amounts inside the corporation. So the CDA balance grows when your company receives specific types of tax-free surpluses is what they're called. Often this would be your corporation sold some sort of investment or some sort of asset and realized a capital gain. And so capital gains, 50% of that is taxable, 50% is not taxable. The not taxable 50% of that gets added to the CDA. Another way is when your corporation receives a life insurance payout. So somebody has passed away and the policy was owned by the corporation. When that death benefit pays out, anything that's above the policy's ACB or anything that's above the policy's adjusted cost base gets credited to the CDA. Another way is when your corporation receives what's called a capital dividend from another company, from another corporation. Those amounts will flow to the CDA as well, and they can be paid out when you want. So this accumulation phase, so these are the ways that you can get CDA and you can create CDA. This is really the foundation of building the tax-free distribution room. You got to create the CDA before you can use it. Secondly, you want to track and verify the CDA balance carefully. Carefully being the key word on this. So before paying out a tax-free capital dividend, your accountant really needs to confirm the available CDA balance. And this is done in a few ways. If you want to get technical, this is called your T2 Schedule 89 in the Income Tax Act. This tracks your CDA activity and the current balance. You also need to keep good internal corporate records to make sure that you've got accurate and compliant records. And you need to track your historical documentation, especially if these are past capital gains that you've had for some time, or insurance proceeds, or an intercorporate dividend. Now, tracking is super important and it's very essential because your corporation can only pay out as much tax-free dividend as is available in your CDA balance. You can't pay out more than you have. Thirdly, is you need to file this capital dividend election. Again, this is for your accountant. Before you pay the capital dividend, the corporation needs to file a capital dividend election with the CRA using this form, T2054. And this filing needs to be a few things. Number one, it needs to be accurate. Accurate is very important. It needs to be timely and it needs to be supported with proper documentation. Again, this is all on your accountant. You need to make sure that they're on top of this. So the election is what formally notifies the CRA that the dividend will be treated as a capital tax-free dividend rather than a taxable one. You need to do it properly. And number 4 is you want to pay out this capital dividend to the shareholders, right? So you've built it up, you've told the CRA that this is happening, and now you want to pay it out. So once this election is accepted and the CDA balance is verified, the corporation can pay out the capital dividend. And this dividend for sure cannot exceed your CDA balance. It gets received by the shareholders 100% tax-free, and you can time it strategically to support whatever you need to support. It could be cash flow, could be retirement planning, could be estate planning, could be buying some big thing. Now, whether you're extracting retained earnings, whether it's for succession, whether it's distributing money to family members, this is where the CDA unlocks the real value. And then 5th, again, recording, maintaining detailed and accurate records. Good documentation is not only important, it is critical. So if the CRA determines that you paid out more capital dividend than your CDA balance allowed, even if it was an error, you could be subject to a 60% penalty tax on that excess amount. So when I told you it was important to keep accurate records and to document, this is why. These are the things that you definitely need to do so you don't pay that 60% penalty tax. You need precise record keeping with your accountant. You need your accountant involved. Don't do this by yourself. You need proper documentation and you need forward-looking tax planning. Again, this is where working with a good accountant is important. And you've seen a lot of our videos on this channel. We talk about the 2 types of accountants. The accountants that look in the past and tell you what's happening and how much you owe. And then we talk about the accountants, the ones that you want to work with, that look into the future and tell you what's going to happen. So all of these things are essential parts of managing the CDA account safely so that you can pay it out tax-free to your shareholders without getting massive penalties from the CRA. Now, here are some strategic uses of the CDA that our clients use for their own wealth plan. So the Capital Dividend Account is not just a tax feature. It's really like a high leverage wealth planning tool that you can transform how you take money out of the corporation, how you can fund your succession, how you can pass that wealth to the next generation. And when you use it correctly, it creates opportunities that really just don't exist through traditional dividends or through salary withdrawals. Now, here are some of the most powerful real-world ways that the CDA can be integrated into your corporate planning strategies and into your estate strategies. So number 1 is it can enhance the corporate-owned life insurance for a tax-free wealth transfer. Now, what does that mean? Corporate life insurance is one of the most effective ways to build CDA. What happens is when the insured person or the insured shareholder passes away, the corporation receives that death benefit. It receives the entire amount tax-free. Any amount that's above the policy's adjusted cost base can then credit to the CDA and can be paid out tax-free to the shareholders or probably your heirs. And you don't have to do it all at once. You can do it over time. So this dramatically increases the tax efficiency of your estate plan, of shareholder buyouts, of family wealth transfers, and of corporate wind down. It's one of the primary ways that Canadian business owners can convert taxable corporate dollars into tax-free family wealth. Secondly, you can fund your buy-sell agreements and your succession plans. So now if you've got partners and you're a co-owner in a business, you need a reliable way to fund a buyout if one of those partners passes away. So using the corporate-owned life insurance and the CDA, again, that shareholder passes away, the corporation receives the insurance payout, the death benefit, the CDA credits are created, anything above the ACB, and then the shares that were passed on to that person's spouse can then be redeemed using tax-free capital dividend. So you can basically give their spouse the money and take back the shares and say, okay, I'm not in business with you anymore. I'm keeping the whole thing. The surviving partners of the company can then now keep full control of the company without having to borrow money to pay out the spouse or like creating debt. The deceased partner's family receives fair tax-free cash, right? Which is probably what they want. They're probably not trying to be in business with the partners. So what does this do? It creates a clean, efficient succession process without causing undue financial strain. Thirdly, this is a big one. It creates estate liquidity and it can prevent forced asset sales. So on death, there's a huge problem. The corporation may owe taxes, but it may not have liquid cash to pay for it. Now, if you didn't plan, the estate might be forced to sell corporate assets or to liquidate other investments or to break up the company or to sell something else that would trigger unnecessary capital gains. And again, at the worst time, somebody's just died. We're not trying to worry about all this stuff, right? We're trying to, it's an emotional, traumatic time. So having the well-funded CDA, the corporation can now pay out a tax-free capital dividend to the estate or to your shareholder heirs, which gives them the money, the liquidity to cover the taxes on death, to keep the business operating, to avoid panic selling stuff to pay for taxes, and to keep these assets in the family if that's what you want. And this is one of the primary reasons that the CDA is foundational to proper estate planning if you've got a corporation in Canada. Number 4 is to get retained earnings out of the company tax-free. You own the company and you've accumulated retained earnings or you've got capital gains inside the corporation. The CDA offers a way to get part of that value out tax-free. Instead of paying high personal tax on either a salary or a taxable dividend, the corporation could gain from selling investments, and then you get part CDA there. Selling real estate, you get part CDA there. Selling a business line or selling some sort of business asset, you get part CDA there, or receiving a capital dividend from some other company. The non-taxable portion of those gains can go to the CDA and then can be distributed tax-free when you want. You don't have to do it right away. So this strategy helps you in a bunch of different ways. Number 1, reducing your long-term tax burden, diversifying your wealth outside of the corporation. This could support your own personal financial goals, and it can help build your personal net worth in a tax-efficient way. And now where do we come in? Why am I even talking to you about this? How do we help you leverage the CDA? So this is what we do. We specialize in helping Canadian business owners, incorporated professionals who have value on their family. We help them to unlock the full tax-saving power of the Capital Dividend Account. The CDA is an incredibly valuable tool, but only if it's structured properly and if it's tracked accurately and if it's integrated into a broader corporate or estate strategy. And that's where you need the expertise. So number 1, it's the comprehensive review of your existing corporate structure and your tax profile. So this is where we'll start by examining your entire financial picture. And this would include a bunch of things like your operating company, holding company, any trusts. We want to talk about your retained earnings. We want to talk about any surplus cash or savings that's in the company. We want to talk about any sort of passive investments that you have, any other assets that are in the corporation or the holdco, any past capital gains or potential past capital gains that could have built your CDA, but maybe you didn't track it properly. Corporate-owned life insurance policies, and what's the ACB value, your adjusted cost base, because this is going to change every year. We want to look at your shareholders agreement and see what happens if you've got multiple owners of the company. What happens if one of these people dies? How does this coordinate with your family succession goals? How does this coordinate with the other partner's family succession goals? Right? And this will allow us to identify opportunities to build up and to use CDA credits effectively. Now, what else do we do? We help to design a tailored CDA strategy, and we would do this in collaboration with your advisory team. It's not going to be just us. The CDA needs to be managed strategically so that you avoid these giant penalties and so that you can maximize the benefit. We work with your accountant, we work with your lawyer, we work with your tax specialist to design the ideal approach for your corporation. And we want to ensure, number 1 is the proper tracking of CDA and all CDA eligible amounts. We want to ensure that the accountant accurately files the Schedule 89 that I talked about and correctly prepares the T2054, the capital dividend election. Again, we're not doing this, the accountant does it, but we need to make sure the accountant does it. Also want to align with your existing corporate structure, with your shareholder mix, with your estate objectives, and maybe even you might need to restructure the corporation. Maybe it's not set up in the right way. It was set up in the right way to get you here, but it's not set up in the right way to get you there. So this collaborative approach makes sure that your CDA is always compliant, that it's always optimized, and that it stays tax efficient and doesn't put you in a bad situation where you've got giant CRA penalties because you did something wrong. Thirdly, what do? We optimize the life insurance, we optimize the investments, and we optimize the timing of taking dividends. So much of the CDA's power comes from how does it interact with corporate-owned life insurance, how does it interact with investment gains, and how does it interact inside your corporate tax structure. And we help you to structure and fund. Usually it's a participating whole life policy, sometimes a universal life policy. And we want to do this to maximize the CDA credits. We also want to position your investment strategies. We work with a company called Harness, and they're a fiduciary investment manager. And so we'll work with them to support your future CDA growth. We also want to time any capital dividend elections at the most tax advantage moments, if possible, and coordinate these CDA payouts with your estate plan, with your retirement plan, or maybe like a corporate wind down or some sort of succession. So this ensures that every piece of your plan reinforces the other pieces. And then 4, we want to integrate into your complete wealth and estate plan. The CDA is not just a tax tool, it is a cornerstone of a long-term wealth strategy. So we want to integrate it with your corporate investment management, we want to integrate it with your retirement income plan, we want to integrate it with your estate plan, with your succession plan. And obviously, because there's insurance, this is risk management, and eventually it's an intergenerational wealth transfer plan. So how do you get the money in the most tax efficient way to whoever you want to get it to? And the result is really, it's a holistic tax efficient system that protects your corporate wealth today and distributes it efficiently, probably to your family tomorrow. Now this video is getting a little long, so let me tell you about some final thoughts. The CDA is one of the most powerful wealth tools in Canada, and most people don't even know it exists. If you're a Canadian business owner, if you're an incorporated professional, or you're an entrepreneur that's looking to build and preserve and transfer your wealth as tax efficiently as possible, then your Capital Dividend Account or your CDA is not just helpful, it's essential. Most owners will focus on earning inside the corporation, but the real opportunity lies in how do you get the money out of the corporation. The CDA lets you move the money out of the corporation into your personal hands or into your family's hands with zero personal tax on properly elected capital dividends. Let me put that in there. Very few tools in Canada offer this level of tax efficiency. There's not a lot of tax-free things in Canada. Canada is very highly taxed. So when it's combined with strategies like corporate-owned life insurance, capital gains planning, a well-structured holding company, or potentially a trust, the CDA becomes a cornerstone of this advanced tax planning. It's a cornerstone of your business succession, and it's really important for intergenerational wealth transfer. If you want your money to go to the next generation in the most tax-efficient way, this is one of those things that you need to do. It helps you to avoid unnecessary taxes, it prevents forced asset sales at death, and it ensures that your estate transitions smoothly. These are the people that we want to work with. Entrepreneurs, incorporated Canadians, and we want to help you to fully unlock the power of the CDA. We want to coordinate with your accountant, we want to coordinate with your lawyer, with your advisory team, and build out a plan that supports your corporate goals, your personal wealth strategy, and your long-term estate vision. And if you want to see how this works and how the CDA can strengthen your overall plan, the time to act is really now. You need to have this stuff set up before you need it, right? It's not something where, oh, okay, well, I died, now I'm going to go do all this work. Well, you can't, you're not here. So you need to set these things up before you need it. How do you do this? You visit our website, safepacific.com. You can book a consultation today. There's no charge, there's no pressure. We will walk you through a customized CDA strategy and show you how to get the money out from your corporate structure, how to set up the life insurance planning, how to set up the investment approach, how to set up the estate and legacy strategy. And also, how does this coordinate with your other advisors, your accountants, your lawyers, maybe other investment advisors or other tax specialists that you have. How do you do that? Again, like I said, it's on our website. There's so many buttons on that website where you can click and book straight into our calendar, or you go to the contact page, send us a message. That comes to me. Someone on the team will reply within 24 hours and we'll set up a time. We can meet all across Canada. All our meetings are generally virtual right now. And before you go, let me ask you a big favor. If this video helped you in any way, please return the favor by clicking either the like button, the subscribe button. Those are really important. If you have any questions, if you have any comments, If you want to yell at me because my sweater is the wrong color, put it in the comments. And if you know anybody who owns a company, if that's you or somebody you know, share this video to them, because really most people don't even know that this thing exists. It's hard enough to run a business. It's hard enough to make money. Please do it in a smart, tax efficient way so that you try to keep as much of it as possible without letting it fritter away and get eaten up by the CRA. As always, my name is Laurent Munier from Safe Pacific Financial. I really want to thank you for watching it. We appreciate every view. We appreciate every like, every comment. That's it for me to date, and I will see you next time.